Hi, friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen,
I'm Jen.
and we had a kind of crazy ass weekend. I just was wrangling four kids trying to do a 24-hour trip. But Jen, we were talking on our Instagram about this like broken bone theory because your poor son fell off of a scooter and broke his wrist right going into school. And what the heck was this broken bone theory that you were talking about?
Well, it's funny. I had seen this as like a fleeting trend on TikTok and thought nothing of it. And then we were talking about Jonathan Haidt, the author of what is it, The Anxious Generation,
Yeah.
and a couple of other books. And he had said something to the extent of kids these days are suffering from fewer broken bones because rather than they are being overprotected when it comes to their physical safety. So they're not allowed to go climb a tree unsupervised. They're not going out and playing, down the road at Bobby and Joey's house or whatever it is. They're being kept under lock and key, yet they are totally unprotected when it comes to their access to the internet, to video games, to all the stuff that isn't necessarily hurting them physically, but can be quite damaging to them emotionally, potentially when unsupervised. And I guess the TikTok theory had been that if you don't break, that basically there's a karmic balance, if you will, to your mental and physical trauma. That if you experience the physical trauma of broken bones as a child, it's kind of a trade-off in lieu of emotional trauma later on in life. So I guess that was the TikTok theory. And so they're both effectively just riffs on the same thing, right? That, you protect too much on one front at the risk of leaving someone totally unprotected on another, possibly more dangerous front, that mental and emotional front. But yeah, I'm dealing with a broken wrist and I've got to take my son to get a cast. And it's just, it's one of these things where God laughs when you make plans. I had the entire fall schedule like optimized to perfection of like this kid in this sport, this kid in this activity, all at the same time, so we could juggle all of it. And now that I've got one of them that can't use one of his hands or whatever, in theory, it throws a little bit of a wrench in the whole thing. But to be honest, I think he's probably enjoying the attention right now at school because like everyone's going to sign his cast. Everyone's asking him how it happened. I used to perversely as a kid be jealous of the kids who had a cast because they would get so much attention. And I only ever had a sprained ankle. And a sprained
I
ankle, you get
remember.
that awful boot, like just like the air
I
cast.
remember you always walking around on crutches. I don't know why.
Always. I
You were
had a
always
sprained
on
ankle
crutches.
every year.
It's the funniest thing.
What a frail child I was. So, I mean, and then plenty of broken bones to boot as well throughout my life. So I've done it all. Like the theory is great. I am emotionally pristine, clearly.
Yeah, seriously. I used to always break my fingers playing like basketball and stuff. But I also had a girl like ice skate over my finger when I was 5. So I don't know if that counts the broken bone. It's more
You
of a
get
severed
like
tendon.
10x the trauma points for getting fingers sliced off, teeth knocked
Well,
out.
it didn't get
like,
sliced off. It just got cut, but it was like I had to go and get surgery on it. But yeah, no, so this past weekend, my kids they like romanticize New York City. So similar to you, actually, Jen grew up like you lived in New York City until you were, I think, 6, and then
5.
moved until 5, and then you moved to the wonderful town of Weston. But my kids, it was like we lived in New York City until my oldest was 5, and then I had a 3 and then a 1-year-old. And so my daughter in her head, she just, like I said, romanticizes New York. She misses her nanny. Like she talks about New York City all the time. And so my husband it was funny. He had like a free night award from Marriott. He's about to like get titanium status because he travels so much, but he had a free night award that was actually 2 free night awards that were about to expire. So he's like, I booked a ticket, I booked a trip to New York City. And I was just like kicking and screaming, was like, I'm not like, no, we have 4 kids, as 8-week-old, like this sounds miserable. And it was actually like wildly fun. I actually missed the city. I was shocked when someone messaged us and I was like, yeah, the city seems so clean. And they were like, really? And I was like, but I think because in my head, it's just so dirty. But it was so wonderful. It was actually
because
like,
of
really
the
nice.
McKinsey sponsored trash cans that are now everywhere. Is there less trash on the street?
No, my theory about why it seemed so wonderful was that A, it was the most perfect weather. It was 80, no humidity. And by the way, in like August in the city, there is nobody there. Like
Yeah, no
everybody
one's
is
there.
gone.
No one's
And
there.
so there was just nobody there. We were able to go to ABC Kitchen for dinner, which is this, like sort of
You love that
fancy. I
restaurant.
love
Yeah.
ABC Kitchen. We went with like the whole crew. But
You
no,
said you got a proper martini.
I did. I got a proper martini. I probably drank more than I normally drank. I think I messaged the next morning like, I feel awful. Of course, there's nothing worse than like having a proper martini and then getting super broken sleep because you're being woken up nonstop by a newborn. But anyway, so that was fun. But now we're back, and so Jen has had this theory, and I feel like it's always like Jen has a theory, but there always
I sound like such a wild conspiracy theorist. I promise I'm not. It's more like Jen is very curious about a lot of things and tries to research them on her own without proper access to the tools that she had on Wall Street. So this is a giant plug for Bloomberg. Please, we need a Bloomberg machine. We need one
Bloomberg.
desperately. Help us.
Well, yeah, because Bloombergs are not exactly cheap. We're doing our taxes right now, and I mean, Jen, we would have a huge write off because Bloombergs are like $28,000 a year. I mean, they are not.
I think
cheap.
that's like starting price, rack rate.
That's the
for
entry
like
level
anywhere. Yeah,
and that actually I think was in like 2007, so it's probably like multiples higher now. But anyway, sorry. So the whole thing is that there is something going on, I think, in the swap spread market. So Jen's going to be educating me at this point. So Jen, you know what? I'm going to let Jen just introduce what we're talking about today because this is like urgent. Jen's like, we have to talk.
I was like, we have to get on and record. And when we talk about, by the way, like the weekend was really annoying with my son having this like broken wrist. This is all I was doing this weekend was like trying to get to the bottom of this little nagging question that I had that was percolating. And I had hoped to write this as an article for last week's newsletter. And I messaged Kristen and I was like, I can't figure it out yet. Like I don't know what's going on. And there will be these moments in the market where you will see something and you're like, this is important, but I don't know why. Or like, this doesn't make sense, but I can't figure out what's actually going on. And then you'll have these light bulb moments where like all the pieces fall into place. And it's truly like you see the Matrix. And for all of you who haven't seen the Matrix yet, go back and watch the Matrix. But I remember on Friday when Chairman Powell spoke at Jackson Hole. He was so dovish. I thought going into that speech, there was no way that he wasn't going to disappoint the markets. Every single risk asset was priced to perfection. Treasury yields were poised to say, okay, there's no way in hell we're not getting a rate cut in September. I was like, even if he gets up there and sneezes, it's going to be a disappointment at this point. And no, he got up there and he delivered a very dovish speech. And I was like, why? Like he doesn't need to at this point. The market has fully priced in this rate cut. And even some of the stuff he was saying about potential risks to inflation from tariffs, I mean, saying like, we may see this as temporary, even if he then goes on to say like, well, but this, that, and the other thing. When you give Fed speak that way, we talked about this before, whenever someone from the Fed speaks, it's so coded. And so he knew exactly how the market was going to interpret that and that it was going to be a very dovish speech, the way he gave it. And I was like, why? Because we're always so focused on the labor side of the Fed's dual mandate and the inflation side. We don't talk as often about the fact that part of the Fed's role is to make sure that we have a fully functioning banking system. And
details.
And I think that there is a potential liquidity crunch coming that quite literally no one is talking about except for one little article I found buried in Bloomberg as a result of something from the Fed minutes from July that I haven't heard anyone else talking about. If there's someone else talking about this, please let me know, because I tried to do as much research as I could. And this is all like purely my own digging. I think there's probably like 3 guys out there who trade the front end of the interest rate curve for whom this is all like, duh. But for everyone else, I think this is stuff that people aren't necessarily as focused on, but that I think is potentially pointing to a tremendous possible stress in the system that the Fed may need to address that otherwise isn't being talked about. So that's where I'm going with this. I'm going to take you guys on a little journey, okay?
And I might stop you as you go through things and be like, Jen, this is like, if I am confused, I might be like, explain this very simple thing that I don't understand. So just giving you that
Please.
warning. I might interrupt to be like, what does that mean?
Interrupt away.
Okay.
So first of all, it's really easy to forget, but over the past several years, we have been in a regime of quantitative tightening. And I've gotten to arguments with some people on social media. They think that the Fed may be slowing its pace of quantitative tightening means it's easing. The Fed has been shrinking its balance sheet. So just to give you guys some numbers, prior to the start of this quantitative tightening regime, the Fed's balance sheet peaked in, I think it was probably like April of 2022 at a little over $9 trillion. And if you have a Bloomberg, you can go look this up. I think like the acronym is like FARBAST index. Now, ever since then, they have been shrinking their balance sheet. There's also a facility that the Fed has called the reverse repo facility. And I'm going to explain what that is in just a minute. But keep in mind that at the end of that same year, 2022, that reverse repo facility peaked at something on the order of magnitude of $2.5 trillion. It is now down to basically zero. So, okay, let's explain. What is the reverse repo facility? The reverse repo facility got put in place all the way back in 2014 to prevent rates from going negative, but it wasn't used a whole lot at the time. It ended up being used more post-COVID when the Fed had pumped a bunch of liquidity into the system, and there was so much money floating around that people had nowhere to go with it. And I'll explain exactly how that ended up happening. But basically what the reverse repo facility is you can park your money at the Fed and the Fed pays you interest. And that interest represents the floor, the absolute floor on interest rates so that they can't go negative. There are countries that have negative interest rates. Switzerland is very famously one that has them right now. We do not want negative interest rates for a whole host of reasons. That's probably beyond the scope of where we're going with this.
And just to remind people, what that means is like you basically give your money to a bank and you're paying them to get it back. So instead of them paying you, you're paying them. So just wanted to like put that out there. And a quick reminder that back to just quantitative easing, quantitative tightening, because this is something that was not in my normal like day-to-day lingo. Like Jen has had to beat this into my head. But the whole idea is that the Fed either is like expanding their balance sheet or shrinking their balance sheet. And so quantitative easing, that was something that didn't we first see it in like the 2008 timeframe done in the United States?
That's when we first implemented it here in the U.S.
In the U.S.
It's done in other countries.
But yes. The idea with that is, we talk a lot about how the Fed can lower interest rates, right? But when we're talking about that, it's lowering the interest rates that are overnight. It's the front end of the curve. It's like the literally like very short-term rates. However, in the case in 2008 when we had this massive problem there, we not only wanted to lower the front end rates, but the Fed wanted to lower longer term rates as well. It's typically the market that is almost responsible for those rates based on the supply and demand dynamic. Like the more people want to buy treasuries, like the lower the rate will be. But what happened is that the Fed wanted to put its thumb on the scale as well. So they went out into the market and they started to buy treasuries as well. That is that idea of quantitative easing. Now, over the last, I think it was, you can correct me, in 2019, that's when the Fed started to quantitative tighten, which means they basically started to shrink
in
their
the late teens.
Oh, they were. Okay.
And they stopped before COVID. And then COVID was QE. And now we're in a regime of quantitative tightening again. And just to think about it again, we always talk about the Fed's balance sheet, but I feel like we never actually talk about like what their assets and liabilities are.
Right.
And the way you can think about this is, okay, what are the Fed's assets? And this is just me talking. This isn't how like a textbook would teach it to you. But this is one way that you can understand how this reverse repo facility fits into everything. So the assets that the Fed is buying are things like treasuries, mortgages, and for a hot minute, corporate bonds, no longer, right? Okay, what are their liabilities? What are they paying interest on? They are paying interest on the money that is parked at this reverse repo facility. So you can think about it that is basically the part of the Fed's balance sheet that is its liabilities. Now we can get into a whole, it's obviously much more complex than that. But the bottom line is that's the whole thing that is shrinking, right? And it's the amount, it's a measure of the amount of excess money in the system. So you talk about quantitative easing. People talk about the Fed printing money. The mechanism by which this happens is people take treasuries, they sell them to the Federal Reserve. The Federal Reserve buys them with money that did not previously exist. And that money then appears in the accounts of these banks that have facilitated the sale of treasuries, either from their own coffers or from the coffers of the hedge funds, asset managers, blah, 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 super sovs, all that fun stuff. So when all that money shows up on these banks' ledgers or in your asset manager's account or whatever it is, that money has to go somewhere. And the whole point is you're going to be like, yay, let's go spend it. And this is going to stimulate the economy. You got to go invest it in things, right? But you don't want to invest all of it in equities and all of it in housing and all of it in the riskiest assets out there. You're going to want to put some of it in effectively cash or in very safe things like money markets. But money market funds are limited in terms of what they can buy. It's not like you say, okay, money market fund, go buy me the safest thing you can find, but like make sure you maximize my yield. No, it's like we can buy T-bills. Like it is very, very, very specific. And you give them that money and they have to put it to work. They can't just be like, well, we're like a hedge fund and we can strategically deploy this as we see fit in order to maximize your return. It's we get money, we got to go put it somewhere. And what happened during COVID specifically was there was so much money being put into the system that ran out of places to go. They literally ran out of T-bills to buy. So when there's no more T-bills to buy, you say, okay, well, we're going to try to make it as easy as possible for banks to go and buy treasuries. So they exempted treasuries from what's called the supplementary leverage ratios, which were rules that were put in place by Dodd-Frank to say, hey, listen, if you are a bank and you're going to go out and buy even these high quality assets like US treasuries, you need to hold all this capital against it. We're going to waive that rule for a second because things are so wild and let you go buy US treasuries to help facilitate effectively quantitative easing, give this cash somewhere to go. But there was still so much cash in the system that a lot of these people who were invested in money market funds and stuff like that said, you know what, just park that money at the Fed and you will earn the bottom of the Fed funds range. And so that's what the floor is effectively that's offered by the reverse repo facility. So that's the reverse repo facility kind of, and its history of how it grew in tandem with the Fed's balance sheet. The Fed has been shrinking its balance sheet, and the reverse repo facility has shrunk from effectively $2.5 trillion to zero. Over the same time frame, the Fed's balance sheet has shrunk by the same amount. So all of the shrinking of the Fed's balance sheet, all of the removing of excess cash from the system has come out of the reverse repo facility. So
which makes sense because I feel like you can go buy like higher yielding stuff. Like why are you buying or why are you parking it at the Fed? Right? Is that the right way to think of it? Okay.
Yes. So there's other things to buy. So why would you go park it at the Fed? Now, where is it going to come from next? Over this same period of time as the reverse repo facility has been shrinking, bank reserves, so all the rest of the cash in the system, they've effectively stayed the same. If you look at the graph of bank reserves, it's like do. But it hasn't, like that average where it averages out, it hasn't really moved. There's no precise mathematical formula for exactly what bank reserves should be as a percentage of GDP, but it probably needs to be a minimum of about 10% of GDP. This is not me coming up with these numbers. This is people much smarter than me coming up with these numbers in my research that I'm trying to understand. But there is no hard and fast formula for exactly where bank reserves should be. So when we think about the money that's going to get drained out of the system next, it's going to come from bank reserves. And I'll explain why in just a second. But we have a historical precedent for when bank reserves get too low, things go really, really bad. So pretty much almost 6 years ago, almost exactly to the date, we had a precipitous drop in bank reserves during a time of quantitative tightening. It was 2019. And it happens very naturally around the date of September 15th. Why is that? Well, that's the corporate tax payment day. So all these corporations that have deposits at banks all over the world, that become part of their reserves, they need to take that money out and they need to make payments with it for their taxes. So this is like a normal thing that predictably happens every single year, right? Well, in 2019, the Fed was undergoing a round of quantitative tightening. And there wasn't much money parked to the reserve repo facility because people didn't need to at the time. We hadn't gone through COVID yet, so all of that wasn't really in play. And what we saw was that in September of 2019, bank reserves got all the way down to 1.4 trillion relative to GDP at the time of 21.52 trillion. So what happened? That sparked what some in the markets affectionately called the repocalypse. So when we hit that point of reserve scarcity, what happened in front end rates was that GC, the general collateral rate, spiked about 400 basis points from, call it the 2 to 250 range, all the way up to 6% in basically one day. The system ran out of cash. And what that means is it all of a sudden becomes really, really, really expensive to borrow money. And it specifically becomes expensive. The GC rate is the general collateral repo rate. That's where you borrow money to fund a levered long position of, say, US Treasuries. So who uses that? Well, we've talked about the basis trade before on this podcast. And the basis trade exists, long story short, that there is a structural richness of futures relative to the underlying cash treasuries that are set to be ultimately delivered into that futures contract at expiry. Over time, the theory is that if you are long that structurally cheap treasury relative to that futures contract, the two converge as you approach expiry, and you just make money by waiting for ultimately that imbalance to correct over time. So if you are a, I don't know, multi-billion-dollar relative value hedge fund, you are doing this trade all day, every day. And because not only do we have the reverse repo facility, we also have something called the standing repo facility that was implemented during repocalypse. We have a cap on where that general collateral rate can be. And that's capped by the upper end of that range by the Fed that says that they will effectively become the lender of last resort to keep those interest rates from spiraling out of control. And so when we had the 2019 repocalypse move where GC spiked by 400 basis points, it was because we had that stress in the system. We had that quarterly tax payment. Bank reserves got down way too low, and it created this massive liquidity crunch, this massive funding crunch. So the question is could we be headed for repocalypse part 2 as we look at where we are now? So we've got the reverse repo facility that has dwindled now to something like zero from a peak of 2.5 trillion. Bank reserves are currently on the order of magnitude of something like $3.3 trillion. So again, they're much higher than they were during repocalypse, but they have to be given our GDP is obviously much higher. So if our GDP is something like $30.5 trillion, we're just over 10% now. And the question is will that be sufficient a month from now after all of these corporate tax payments are made? Or are we going to see a massive stress in the system that requires intervention from the Fed to keep everything functioning so we don't get a 400 basis point spike in funding rates, so we don't get a collapse of levered long positions? And so when you think about that, all of a sudden, it's very scary to think that we might be on the precipice of this massive financing constraint where the entire financial system of the US breaks down because we don't have sufficient bank reserves after these payments are made. There's not only the September 15th payment date looming, we've got the Treasury re-upping its cash balance. They are going out and issuing T-bills again. So you're not just going to park your money in a bank. You're not just going to go park your money at the Federal Reserve when you can go out and buy T-bills. Because by the way, remember that owning US Treasuries is more tax advantageous than parking your money at the Fed and receiving that interest, because the money from the Fed is not exempt from taxes the same way that money from your Treasury investments is, right? So, and by the way, Treasury investments should be higher yielding. So like there's so much more to go invest in. Yeah. You're not just parking your money at the Fed and you're not just parking it at the bank. You're going out and it's invested, right? So money market funds have stuff to buy. Like we want them to. That's all really good, right? So because there's nothing else to drain from the reverse repurchase facility and bank reserves are at this critical low, any additional tightening of financial conditions could push things over the edge. I think Chairman Powell knows this. This was in the Fed minutes. So I think that it's quite possible that going up on stage at Jackson Hole, he had this at top of mind when he gave such a dovish speech indicating that the Fed is going to cut rates. Now, what you might say is, well, hang on, I don't know really why like a rate cut helps if we're facing like a liquidity issue, right? Doesn't that mean we need more Fed interventions along the lines of the rest of its toolkit, whether it be other things like the discount window, these repurchase facilities, blah, blah, blah. The thing is, though, is it's really hard to say, okay, we're going to go do a round of quantitative easing and start de facto printing money, right? Like everyone says so glibly, when interest rates are still, in that range of 4.25 to 4.5. So you don't bring out the bazooka when rates are still relatively high. There's kind of an order of operations to doing things. So a rate cut needs to come first. I don't know that it doesn't come with additional things. And one of the things that has been pushed for specifically by Michelle Bowman at the Fed is, remember we talked briefly about how from April of 2020 to April of 2021, they exempted the purchase of U.S. Treasuries by banks from the SLR regulations. So banks didn't have to hold the same kind of capital against their purchase of treasuries because that was part of facilitated quantitative easing. And then they let that exemption expire in 2021. This has become a highly politicized issue. There was the perception that, well, the banks shouldn't profit from quantitative easing. Therefore, we need to effectively put penalties on them to make it less attractive for them to just hold treasuries and benefit from the fact that all this liquidity is going into the system. And now the question is all right, well, the banking system, I hesitate to say like might be on the verge of collapse because I don't think we're necessarily there, but I don't see what's that different between the current set of circumstances that we've set up and the repocalypse. So,
well, and by the way, in 2019, like it's not like things were terrible. I mean, 2019 wasn't like this year. I mean, 2020 is like a year that you think of like, oh my God, like everything was collapsing, or 2008. 2019 was just like, just like bopping along. I mean,
it's easy
other than
to say that as someone who was not in the bond market at the time.
Okay.
That's not what it felt like in the bond market at the
Got
time.
it.
Again, the reason it's called repocalypse wasn't because it was a...
But it wasn't like there was some huge external factor that everybody was focused on. It's not like it was 9/11 or these big things, SVB. It was just like repocalypse. But for your average person, I mean,
the average person had no idea that this went down.
Right. That's yeah, exactly.
Yes.
So
100%. And so what signs do we have that this is potentially on the horizon? Well, the best indicator to look at is the difference between Fed funds and SOFR. So these are two quasi-identical funding rates. And we look at that spread as an indicator of stress in the system. And that spread has been hovering right around 0. So Fed funds SOFR gets more negative, meaning SOFR cheapens relative to Fed funds when there's a liquidity crunch. And 1 year Fed funds SOFR has gone from 0 to -5. Is that the biggest move in the world? No.
5 basis points? So no,
Yes.
so it's like, yeah, okay.
Yeah. So it's not the biggest move in the world, but it's starting to show some signs that people are paying attention to where these rates might be if nothing is done in the future. So coming back to that SLR conversation, Michelle Bowman has been saying that we need to re-exclude treasuries from SLR. And she gave a recent testimony, I think back in June. She laid the problem out quite simply, right? She said, and I quote, "When leverage requirements become binding, banks are incentivized to reduce engagement in lower risk, lower return activities, including intermediating the US Treasury market." So they are trying to change that incentive, obviously, to encourage banks to be able to buy treasuries, which will help everyone now keep rates lower, which is what everybody wants, right? For a long time, there was political pressure standing in the way of this, saying, well, no, the Dodd-Frank, blah, 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 blah. This is all a result of Basel III and stuff like that. So these are all the capital requirements that were put in place. And I don't want to get too much into the politics of this, but that would be, I think, an additional announcement that we could see in September, along with a rate cut that would address this issue of potentially not enough money in the financial system. So this has become much more of a bipartisan issue now. So I think that this is something that we could see get passed along with a rate cut in September. And I think that potentially like being cognizant of this rather than letting it surprise the market is important, because all of a sudden, if you see this kind of legislation happen, it's like, well, why? I want everyone to understand that if this legislation does come to pass, this is why, because we need to avert a crisis in the banking system.
But this would be something that is passed by Congress, not something that the Fed just says, this is now like, we're going to be exempting.
That's a great question. I don't understand enough of the regulatory oversight. I know that she's been leading the charge for a long time on this politically and is the one who's been giving speeches.
Got it.
So she basically gave a statement at the end of June, and like it was in conjunction with the Office of the Comptroller of the Currency and the FDIC. Like these are all the people who weigh in on these things. So I don't know exactly who has to make that decision. It's at very least a recommendation from the Fed, if nothing
Got it.
else.
Okay. Yeah. I mean, it's interesting how in some cases, we talk about the tools that the Fed has, whether it's like by treasuries or different things that they can enact versus like having to get, again, Congress involved, where there a lot of the politics come into play.
Yeah, I'm reading
mostly for worse.
Elizabeth Warren's letter where she concludes, if the banking agencies gut this requirement, the big banks will load up on more debt, pay out more money to shareholders and executives, and put the entire economy at risk of another financial crash. There is no valid rationale for your agencies to impose these risks on the American public. So that was her response this June to the proposal that the SLR be lifted. So that's been the political opposition to this getting done.
Got it.
I do think we are at risk of a much more imminent collapse if it's not lifted, but what do I know? Now, all this being said, right, like a key piece of this is the fact that A, the Treasury is issuing more T-bills, right, because they're rebuilding their cash balance, and B, that we just had the big, beautiful bill passed. So like a huge caveat to all of this is, well, how much Treasury issuance is about to flood the market as we go about funding our now expanding deficit? And what does that mean? Right. So,
yeah. And a reminder to everyone who might not have paid attention in like just how the government works 101, because like we're not actually taught that. The Fed and the Treasury are two different things. So the Treasury funding themselves is not the same thing as the Fed coming in and helping to buy to facilitate all of that. So something that, again, like to me, it's always just like, well, the government's one just giant blob and it's all, whatever they're doing, it's all doing it. And it's like, no, they're two totally separate parts of the government.
You raised such a good point, Kristen, because we talked in the past earlier this spring about people who were calling for effectively monetary policy solves to fiscal problems and not understanding the difference between the two. And I think, said differently, right, we've talked a lot about how fiscal policy with the tariffs and with the big, beautiful bill is impacting that labor picture and the inflation picture for the Fed. We've talked so much about that, like till we're blue in the face. But what we haven't talked about is how that plays out then with respect to these very technical funding considerations for the system as a whole. And I think that A, it's something that very few people understand or know how to look for the stresses in. And B, it's also something that's evolving in real time, because we talked about T-bills earlier this summer as being something that now might be bought up by all these stablecoins issuers, right? That's a potential path there. So what does that then mean? So there's a lot of interesting questions to this because it's always evolving. And like, we haven't really talked about this more nuanced relationship between monetary and fiscal policy that I think is at work here in a way that I think requires very interesting policy approaches that aren't as cut and dry as we always talk about the Fed. Dual mandate, dual mandate.
So we're basically watching to see what happens in September 15th, when all these corporations have to pay their taxes.
Yeah. And I have no idea what ends up happening when you then drain those reserves and you're coming up within 48 hours of a Fed meeting,
which is September 17th. So the tax deadline is the 15th, and then the 17th is when the Fed will come out and probably do a rate cut, is what it sounds like Chairman Powell hinted at.
Yeah, I think at the very least, where I come back to with all of this is so many people were in our DMs the day of Jackson Hole saying, oh, Powell's caving to political pressure to cut rates, or like, oh, well, the labor reports really were that bad. And I was like, did you feel that way? Day one? Like, it just felt like there was a missing piece to the puzzle. And my hypothesis is that this potential stress in the banking sector lends credence to the idea that monetary policy does in fact need to be easier to prevent there from being these stresses in the system. And that's really, that's all I'm getting at here, that there's an additional wrinkle that I just think nobody's talking about and people should be.
I love it. So we'll keep an eye out on the differential between SOFR and Fed funds, right?
And to see what kind of progress is made on this issue of SLR, because if the SLR exemption is not reinstated, said differently, like if banks can't buy treasuries free and clear, then it's hard to see a world in which you get the full impact of a monetary policy easing on the rates market.
Awesome. Well, we usually do the skinny ons at the end of the week. We're trying to front load this. I think we're going to be trying to do our Moneyball episode, hopefully sometime in the next couple of days, knock on wood, towards the end of the week. And then we have this really amazing podcast interview coming out. And actually, the other reason that we had to do this early in the week is that Jen also was like trying to free up time for the sales and trading course. We've had so many people in our DMs asking about that, and she's just trying to get that out, like past the finish line. So we're close.
Past the finish line. Yeah, we're trying to get it off the starting blocks. So just so you guys know where I am, I have 21 modules fully recorded that I need to now edit, add graphics to, animate, all this fun stuff. We do this all ourselves and put so much heart and soul into all of this work to make sure that the courses we're delivering to you guys are not us droning over a PowerPoint. Nobody wants to see that. Nobody wants to hear that. We know that's not how you guys learn. So we want it to feel like you're learning through the same kind of conversations that we're having here. Maybe I should just get Kristen on the other end of a Zoom and talk to her and record that and call that a course.
Well, no, because I mean, I saw what you've done with the very first module, because it's not just the conversational aspect, it's all of the visuals and the graphics. And that's the part that is so time consuming. And I think you were like, you did that first one. I think it was like a 20 to 30 minute video. And again, it's a huge lift. And so we're doing it with every single video. And so I do want people to understand just the amount of heart and soul that goes into this. I mean, with the sales and trading course is again, it's working its way through. I mean, the investment banking, private equity one, like these are just, again, the culmination of everything we've learned and poured into, and then they go off into the universe and we're
trying to get all the information out of our brains and into yours. And it's very hard to synthesize down quite nearly a decade of sitting on a desk, getting that real-time feedback, seeing how things work, testing things out, building that intuition, being like, okay, how do I sum that up in a sentence? It's really, really challenging. And I love the challenge, but we're trying to do so much as well simultaneously. So if you guys don't hear from me for a little while, it's because I'm going back into the hole to work on these things.
I love it. But anyway, so stay tuned. We'll be coming at you guys probably in another few days. So we're super excited. We have so much really fun stuff coming, and actually just some of the most amazing interviews scheduled into the fall. We had taken a break because I, just had a baby. Like, he's not even 2 months old. He's turning 2 months tomorrow. So we took off this time, which then translated into obviously continuing to do a lot. But we do resume again, like a lot of these formal interviews. And so there's just be a whole bunch of really kind of fun stuff coming at you guys. So stay tuned. And if this is helpful, please leave us a written review in your whatever podcast platform of choice. And we will see you guys next week. We will see you guys in a few days.
Okay,
bye.
For real.